Hey guys, Tim Melvin here. I started in the financial markets back in the 1980s. The primary way of gathering clients was to cold call on the telephone, which, bothered a lot of people. But, you know, my first job was a door to door salesman. So, being hung up on didn't bother me a bit. As long as they didn't turn out the dogs or punch me in the face, it was a win. So, you cold called and you would call people up and you try to sell them mostly tax-free mutual funds or preferred stock offerings. That was the easy stuff. And as I became a little more aware of how investing really worked, primarily thanks to another guy in the office who was a big fan of Ben Graham, Warren Buffett, Marty Whitman style investing, did a lot of distressed. And he told me once, he said, the harder it is to explain an investment uh, to a client or potential client, the more likely it is it's going to make a ton of money. And back in the time, one of the hardest things to explain to a client or cold calling in my case was why on earth you would want your potential new customer to invest in a bankrupt utility. Utilities were toxic at the time. Everybody had built nuclear power plants and they all had massive cost overruns, which were leading to, contentious discussions with consumer groups and regulatory agencies about the need for rate hikes to offset, some rather large losses. There were a couple of bankruptcies that occurred. A lot of the preferred stocks, actually, they stopped paying dividends, but they were cumulative preferreds. So if these dividends went unpaid, they were still owed to the shareholders. So they just kind of piled up over time. And if the utility ever wanted to get their act together, refinance, do it, be taken over, those dividends had to be paid off. So we bought quite a bit of those. We bought the bonds, we bought the common. We had access to some pretty extensive analysis of what they were all worth. And of course, my friend there in the office was brilliant at checking and rechecking all this stuff. Um, and it ended up, I mean, cold calling somebody, "Hey, I want you to buy a bankrupt utility today. That's, by the way, not paying dividends." It was a tough sale, but everybody that invested in that, I'm the returns were massive. Returns that paying $30 for a share of preferred stock that eventually was redeemed at par plus 25, 30, $40 in dividends. Common stock that came through the bankruptcy process and ended up doubling, tripling, and even quadrupling over time. So buying into these just highly toxic assets um, ended up creating quite a lot of wealth. It really worked out well. And then moving forward, Drexel Burnham Lambert was a firm that they were a good um, investment banking firm. They did a lot of stuff with distressed and emerging companies. And in the 1970s, they hired a young man by the name of Michael Milken. Milken had done a grad paper on why high yield bonds, which back then were nothing like what they are today. High yield bonds were almost entirely fallen angel bonds, bonds that had once been investment grade that had collapsed. There was no public underwriting of less than investment grade bonds for just decades in there. It was all the public would buy. If you had a more speculative bond that you wanted to sell, you took it directly to the big pension funds or the insurance companies who were the primary buyers back in those days. They didn't hit the market. Milken created that market. He changed American business, I think, for the better. People will argue about that. Um, Eventually, I think he got a little bit too big for his britches, perhaps. The regulators were all over it. And unfortunately, they were using a lot of junk bonds to fuel takeovers. And it was just a ton of insider trading going on relating to those takeovers. Eventually, all of this, together with a couple of spectacular deal failures, and the junk bond market collapsed, absolutely imploded in on itself. In 1990, Drexel Burnham Lambert went from being the hottest firm on Wall Street to being bankrupt. Mr. Milken, of course, eventually pleaded guilty to some charges. We'll get into that's not a story worth getting into, but it's a couple great books on the topic. Um, He did some time in jail, and the junk bond market imploded, just collapsed in on itself. They were toxic, right? Because there's a ton of closed-end funds. My firm at the time, Dean Witter, did a bunch of high-yield bond closed-end funds. We had a guy who knew Mr. Milken was kind of plugged into that high-yield bond pipeline. Um, and so we did a bunch of closed-end funds that, with 14, 15% dividends at the time. That fund blew up. Those closed-end funds blew up big. They were trading at massive discounts to net asset value, paying huge streams of dividend income. People that had the courage to buy those toxic assets at the time made spectacular amounts of money. In 1991, the market rebounded just by itself 40%. The compounded annual returns from 1991 forward were pretty close to 20% over the next decade. Now, there were some investment bankers that Drexel, Burnham, Lambert, Mark Rowan, Leon Black, Josh Harris. These three guys had been investment bankers in various roles at Drexel Burnham. And when it all blew up, they all got together and they formed a private equity firm called Apollo. Apollo's first endeavors were they went out and they bought up the bonds that had collapsed of deals they had worked on. So they knew these deals inside out cold. And they bought them and they restructured them and they sold the business for massive profits. They looked at these and said, yep, they look toxic, but if we go in deep and we restructure this, not so much. They made a fortune. That, my friends, is how Apollo Global, one of the largest private equity and alternative asset firms, came to be. They had the courage to step in and buy assets that other people thought were toxic. Now, go ahead a couple years, 1992, young man from Arkansas strolls down 1600 Avenue, plays a little saxophone on MTV, and becomes president of the United States. Now, he's looking at healthcare, and he knows that healthcare needs to be reformed. Bill Clinton doesn't go to an advisor. He doesn't call up one of his favorite congressmen. He doesn't call anybody from the industry and ask him what to do. He turns to his wife, Hillary Clinton, who, is not an unintelligent woman. She was a lawyer, had, excellent marks and, did very well in school, had a promising career at the Rose Law Firm there in Arkansas. And he asked her to reform health care. It didn't go well. The market did not receive it well at all. And healthcare stocks sold off quite a bit. They were toxic. Nobody wanted them. Because they were terrified of what Mr. and Mrs. Clinton might come up with to handicap the healthcare companies in the name of serving the consumer. This has been done many, many times. We won't go too far down the political road of this, but the atmosphere was very toxic for healthcare stocks. Had you bought the toxic assets like Merck, Pfizer, Johnson & Johnson, Schering-Plough, any of the other major drug companies at the time, you have made a fortune since then. Over the next several years, healthcare stocks were a continual leader. I think flash forward, Asian stocks collapsed in 1997. The totally overheated Thai economy blows up. Along the way, it takes the U.S. equity markets with it and distort global markets, leading to the collapse of long-term capital management in 1998. This creates a huge mess in the markets because there's margin calls everywhere. Remember, they had like $10 billion controlling, 400 billion or some obscene number of assets. The leverage was just off the charts, 80, 100 to 1, something insane number. Little fractional returns were 45% compounded, which was great until it blew up. When it blew up, everything involved in any type of arbitrage strategy or spread trading strategy just blew out. So risk arbitrage, which in the 70s was, like 30% raw returns and slowly narrowed going into the 90s, and long-term capital had bought those spreads way in because they would do these trades big, in the terms of tens and hundreds of millions of dollars position sizes, and they didn't care. They didn't need a 30% raw return. They could take a 2% raw return or 5%, lever it out 40 to 1 and turn it into a pretty big number. When all of that blew out for the first time in a very long time, risk arb spreads blew way out. So there was a period of time, and it didn't last long. Uh, but there's a period of time, I'll say 3 to 6 months, where risk arbitrage was once again a uh, massive winner because those assets were viewed as toxic. They had exploded. Bunch of risk arb funds had blown up because of it. Some other things was, statistical arbitrage happened. Currency pairs, which I had nothing to do with. The others I did a little bit of. Um, Mortgage bonds absolutely blew out because there was big dumping of various categories of mortgage securities all over the world, and equities in general. They dropped very rapid 20% because stocks, once again, were toxic. The world was going to end. Long-term capital had blown up the planet, except they didn't, and they got bailed out. And the rest is history. If you bought stocks, you made all your money back relatively rapidly as we headed into the last leg of the internet bubble. Speaking of which, next up, the internet bubble pops. Internet stocks go from the things that you must own to the things that you dare not own. This was a nasty collapse. I mean, the markets were down over 50%, peak to valley. Internet stocks, it was way worse than that. You had stocks collapsing, going from 100 to zero. Just great companies, going from triple digits down to single digits. That happened all over the place. If you go back and you look, technology was so out of favor that on a split adjusted basis, Apple traded for about a quarter. Now, in today's terms, in real terms, that was about $8 at the time, as I recall. It was a single digit stock price for Apple. Microsoft got down into 20s, into the teens at one point, as I recall. Again, adjusting for the splits on that 20. So that was down into the teens. You looked at stocks like Priceline, traded basically split adjusted at pennies. You look at, Amazon. Amazon was on Forbes list of Barron's. List of companies that weren't going to make it, and it was either Barron's or Forbes. I have to go back and check that. It was one of the two. They said that they probably wouldn't make it. Their convertible bonds traded at 30 cents on the dollar. Fortunes were made. If you went in and you looked through and you sorted through these toxic assets and found the ones that were actually really good companies with great prospects, just way out of favor at the moment, you made a fortune. We were buying back then at less than 50 cents on the dollar bonds of companies that had never missed a payment, where the estimates of what would be recovered if they did go bankrupt were 60 and 70 cents. So worst case, you were making 20, 40% or more on your money. Best case, you were going to par out and collect big yields along the way. And we collected a lot of those along the way. Again, for those who had the courage and fortitude to step in and buy toxic assets. Not everybody does. Matter of fact, most don't. The perception of being toxic, it's much more exciting to buy what's popular, what everybody loves, that never ends well. But buying the toxic is hard to do, but it's where the money is. So now let me just with the great financial crisis, of course, the banks that survived and the real estate investment trusts that survived that mess made people absolute fortunes over the next several years. They were viewed as toxic. Nobody wanted them. The world was going to end. Even as we got out of the worst of the GFC, we were bailing out the banks, and it was terrible. And real estate, it was awful. People's homes were still going down. There were still foreclosures. Commercial real estate was still struggling. If you had the courage to buy the best of those toxic assets, again, you made a fortune. So now, let me introduce you to a few people. First off is Richard Rainwater. Nobody's ever heard of Richard Rainwater. Richard Rainwater was worked for the Bass Brothers, ended up forming HCA Healthcare, was an early investor in that with Rick Scott, former governor of Florida, now a senator and billionaire. Mr. Rainwater's made his fortune investing in stuff nobody else wanted. He was part of the Disney reorganization, made millions. He was involved deeply in oil and gas and real estate at points in time when nobody else wanted to buy. He would jump in, buy, sell when everybody wanted it, and he made a fortune. And he once said, and this is one of my favorite quotes of all time, Most people invest and then sit around worrying about what's going to blow up next. I do the opposite. I wait for the blow up and then invest. Well, when he passed away, he had literally billions of dollars from using that philosophy, not backing away from toxic assets or assets that are perceived as being toxic, going into the pile, admittedly at times, of garbage. I mean, when you're digging in the internet pile in 2003, you're digging through garbage. But in that garbage, there were diamonds. And the people that took the time to dig for the diamonds are rich today. So um, that's number one. Andy Beal. Andy Beal is one of my favorite characters in all of American finance and, for that matter, history. Uh, Beal is a banker. He's a mathematician. He's a brilliant guy. He's the CEO of Beal Bank, which has the highest return on assets and equity of pretty much any bank I've ever run across. He's also the subject of a book that should be on your must-read list. Order this one today. It's called The Professor, the Banker, and the Suicide King. And it's the story of Andy Beal going to Vegas. I remember, mathematician, and he took on the very best poker pros of the day. And you were talking Doyle Brunson, Phil Ivey, all of them. And he played them heads up for a very long time. Eventually ended up losing some money, but he battled them hard. And they took all of them and their combined bankrolls to keep up with him. He played them tough. He's just a brilliant guy. Andy Beal made his money at 19 years old. He bought some rental properties, rented them, and he just kept going along. In his early 20s, he went to D.C., bid on some federal auctions, bought up a bunch of properties for about $200,000, sold them a few years later for over $1 million, making him a millionaire in his early 20s. They eventually bought some tower apartment buildings in the 1970s. He and his partners hired a security guard to stand guard. This is Newark, New Jersey in the 1970s. Not the safest place to be for anybody, much less a couple of guys trying to repair an apartment building on their own. So they oversaw the work. They were on the site and they hired security guards to keep them safe, and eventually sold the building for a massive profit. Now, Mr. Beal shows up when there's nobody else around. All right. If we look at 1990s, he went in, he had conversations with an SNL in San Antonio, and he got a list of the loans. And he literally drove around San Antonio and he looked at all of these houses on which there were mortgage loans that were in trouble. And he went back and he bought all the loans for the ones where he thought the houses were good houses that he could eventually resell. He made an enormous amount of money doing that. Since then, he's just some of the other things he's done. When Enron blew up, he bought power generation bonds again. Boom, big money. After post 9/11, air travel came to a halt. Airline equipment trust certificates plunged to pennies on the dollar. He bought them, made a fortune when travel again restored. And of course, commercial real estate loans in 2008, he again made an enormous amount of money. Now, at Beal Bank, the joke is that, because when there's nothing to do, Beal does nothing. He has a race car that he likes to drive around racetracks in the Dallas area. He's a mathematician, has sponsored some math prizes, so he does a lot of work there. And you can see the head count go down, apparently, at Beal Bank headquarters. And then when there's something to do, a lot more cars in the parking lot, apparently. We thought one time of just putting a camera on the parking lot and just watching the ebb and flow of traffic in and out of the bank. He doesn't do anything when there's nothing to do. He lends money out, he takes deposits in, and he lives on the spread. When there's a toxic situation, a disaster, something that is generating the type of chaos that creates massive opportunities, you can look for Mr. Beal to come out of his cave and get busy buying. If you yell toxic assets, get out of the way. Andy Beal's coming. He's bringing money, and he's going to leave with a lot more money than he arrived with, because he understands that when nobody else wants it, if you can go through the pile of garbage and find the diamonds, you're going to get really, really rich. Okay, now my final person is it's one of the best stories ever. Hetty Green, the Witch of Wall Street. Man, this was one of the most unappealing women in all of history. Uh, she was a miser. She was not a nice person. Traveled around with a gun in her pocket. Not a lady to mess with. She was also one of the smartest and best investors, female investors that ever. Well, she's one of the best investors that ever lived who happened to be a female. We're going to put it that way. Most of the time, Hetty Green kept her money in mortgages, loans. Think fixed income. That's the modern day equivalent of fixed income. She was making loans to people with good credit ratings that could pay it back, and mortgages on buildings where if she had to take them over, she still made money. So very conservative portfolio, earning a modest rate of returns. She also said she never took advantage of anybody in a lending situation, even when she could. Um, she charged a fair rate for a fair return, and she treated everybody fairly. So not likable, but a good businesswoman and very fair. Now, she once said, I buy when things are low and nobody wants them. I keep them until they go up and people are crazy to get them. That was her investment philosophy. When things blew up, and back then you had crisis all the time, just like today, every 4 or 5 years you had a blow up on Wall Street. Well, Hattie Green would kind of break out the pocketbook. She always had a lot of cash around, and she would buy uh, real estate, and she would buy stock in railroads, which were the internet and technology stocks of the day. Um, in 1907, leading up to 1907, which was a panic, um, and valuations were stretched. They were extremely high, kind of like I've been warning you about recently. Um, and so she just started building cash, and she warned everybody, look, this can't end well. There's no way. Stocks are at X times earnings. Asset prices have been going up. It's crazy. This is the same thing I was yelling in 2009, 2006. Anyway, Hetty just built cash and built cash and built cash, and then it all went to hell. And the markets were strapped. The economy was going, into the toilet. There was no Fed to bail them out. There was nothing. What bailed them out was J.P. Morgan and Hetty Green. And there was a meeting of all the financiers, and Hetty was at that meeting. She was the only female invited, but she was also one of the few people with the cash to make the loans that the city of New York needed. Now, again, she had the city of New York over a barrel. She could have charged almost anything. She gave them a fair rate at a fair price. And again, she also bought railroad bonds and she bought real estate. So she came out of it, at the time, richest woman in the world. When things blew up and prices were low, Hetty took her cash and she went down and she bought. When everything was more exciting, well, she sold. And it goes back to the old Henry Clue's, 50 Years on Wall Street book, where he talks about the old men hobbling on their canes down to Wall Street when things are collapsing, buying stocks, holding them until the markets recover and everybody's happy. And then they would sell the stocks and put as the Clues called it, the overplus back into their bank account. So looking at history, buying toxic assets has been extremely successful. Energy in 2020. COVID, everything else piling up. Energy was down 35%, up 54% next year, 65% the year after that. Real estate in 2008 got clobbered. 6 of the next 7 years, real estate beat the S&P 500. That's just on an unmanaged index. More selective buyers, again, made far more than that. More importantly, they got rich. And financials down in 2010. Then huge years in 2012, 2013, 2018, financials down again, up big in 2019. Guys, this cycle goes on and on and on and on. What's toxic today? Well, financials, banks are toxic as hell right now as we speak. Nobody wants to buy banks because they're all going to collapse in the spreads and the deposits and blah, 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 and everything's leaving and it's just the end of the world. It's not. And we've been over that for a lot of reasons. Most of the banking industry, like 99.9, is fine. It's healthy. It's going to recover. They're currently trading at less than book value, very low multiples of earnings. Their balance sheets are in good shape. The loan portfolios are not in awful condition. Credit conditions are still really, really good. Those banks are going to recover, and people that are able to buy them now when they're toxic are going to make a fortune. Pick up any financial publication and you can see that real estate, once again, is toxic. People that buy real estate here, not downtown office, that really is toxic. We'll get to a point where that is attractive. But right now there's there's no diamonds that I can see amidst the rubble. In the banks, there's more diamonds than that thin layer of rubble on the top, and it's really time to be aggressive with those toxic assets. But then let's get to natural gas. Natural gas is down at ridiculously low prices. The Energy Information Agency here in the United States thinks it, almost doubles from here over the next couple of years. I think that's an understatement because I think a lot of marginal production is going to drop off over the next years because they simply cannot afford to keep pumping. Fantastic news for companies, by the way, that are consolidating the energy industry. We do know of a couple of those that we're really fond of, and it's time to be buying them. But natural gas is completely toxic. But Europe's eventually going to have to up their demand for liquefied natural gas. The Freeport LNG plant is back up and running. There's more LNG plants coming. We are going to be the major exporter of LNG for decades to come. So there's toxic assets out there that, regardless of what the market does in the short-term interim, they're going to be a lot higher 3 to 5 years from now. There are legitimately a few toxic situations that can make you incredibly wealthy over the next, let's say, 3 to 5 years. That's kind of the time frame that these recoveries usually take. The question is, are you willing to step up? Or are you going to keep chasing the dreams that everybody's chasing of some nano cap AI stock becoming the next Google? Google is the next Google. Now, when AI blows up and runs into its inevitable problem, there'll be a bunch of bargains around. And then when it's toxic, will be the time to get interested, much like the internet blew up. Even though a lot of those companies were great companies and they really did change the world, they were too expensive. They eventually became toxic, and that's when it was time to buy them. So look, guys, throughout financial markets history, buying into toxic asset classes, buying the best securities in these businesses that everybody's terrified of has been the source of many fortunes, including a large part, by the way, of Warren Buffett's, but story for another day. Anyway, learn to love the toxic. Toxic situations can make you much more money than all of the pipe dreams that are continually sold by Wall Street as the next big thing. The next big thing kind of never seems to be, or if it is, the big just get bigger. So the real opportunity for us as individual investors is to go where nobody else wants to go. And I'll leave you with this final thought. Charlie Munger was asked a few years ago if he thought he could beat the market going forward. He said, no, there's too many analysts, too many eyes, and too much money chasing the market. So beating the S&P 500 with a large sum of money would be almost impossible. However, if you had smaller sums of money and you were looking at, illiquid, less liquid, less well-known situations, then you probably had a really good chance of outperforming the broader market. It's toxic. It ain't popular. It's probably not as liquid as, say, being able to trade 1 million shares of Google at a time. Got to learn to love the toxic because that is where the real money is for us as individual investors. So anyway, guys, I'm Tim Melvin. Thanks for spending a little bit of time with me. Learn to love the down, learn to embrace the toxic, and a few years from now, you'll have a lot more money than you do today. Thanks again.